55 investing terms every investor must know. Basic terms. Stock. A stock represents ownership in a company. When you own a stock, you own a piece of that business and can benefit from its success through price growth or dividends. Share. A share is a single unit of ownership in a stock. If you buy 10 shares of a company, you own 10 parts of its total outstanding stock. Dividend. A dividend is a portion of a company's profit paid to shareholders, usually in cash. Not all companies pay dividends. Many growth companies reinvest profits. Portfolio. A portfolio is your collection of investments, like stocks, ETFs, or mutual funds. A well-diversified portfolio helps manage risk. Asset. An asset is anything that holds value, like stocks, cash, or real estate. Assets are what you own. Liability. A liability is something you owe, like a loan or a credit card debt. It's the opposite of an asset. Equity. In investing, equity usually refers to ownership in a company through stocks. In personal finance, it's the value or assets minus liabilities. Market cap. Market cap is the total value of a company's outstanding shares. It's calculated by multiplying the stock price by the number of shares. IPO. An IPO is when a private company sells shares to the public for the first time. It marks the company's transition to being publicly traded. ETF. An ETF is a basket of investments that trade like a stock. It's a simple way to invest in many assets at once. Mutual fund. A mutual fund pools money from investors to buy a mix of assets. It's managed by professionals and priced once daily. Index. An index tracks a group of stocks and shows how the market or sector is performing. The S&P 500 tracks 500 large U.S. companies. Broker or brokerage. A broker is a platform or a person that lets you buy and sell investments. Popular brokerages include Fidelity, Robinhood, and Schwab. Market types. Bull market. A bull market is when prices are rising over time, often with strong investor optimism. It's typically tied to a growing economy. Bear market. A bear market is when stock prices fall 20% or more from recent highs. It reflects widespread fear or pessimism in the market. Correction. A correction is a temporary 10% drop in a stock or index. It's common and often helps reset overvalued markets. Recession. A recession is a decline in the economy lasting at least 2 quarters. It often includes job losses, lower spending, and weaker markets. Volatility. Volatility measures how much prices swing up and down. High volatility means bigger and more frequent price moves. Liquidity. Liquidity is how easily you can buy or sell an asset without affecting its price. Stocks with high trading volume are usually more liquid. Capital gain/loss. A capital gain is a profit from selling an asset for more than you paid. A capital loss is when you sell for a loss. Analysis terms. Fundamental analysis. This method looks at a company's financials, leadership, and business model. It helps determine if a stock is a good long-term investment. Technical analysis. This approach uses charts, price patterns, and indicators to predict short-term price movements. It focuses on trends, not company details. Earnings per share. EPS is a company's profit divided by its number of shares. It's a key measure of profitability. Price to earnings ratio. This tells you how much investors are paying for each dollar of earnings. A higher PE ratio may suggest high expectations. PEG ratio. The PEG ratio adjusts the PE ratio by a company's growth rate. It helps show if a stock is over or underpriced based on its growth. Price to book ratio. This compares a company's market price to its book value, assets minus liabilities. A lower PB can signal undervaluation. Return on equity. Return on equity measures how efficiently a company uses shareholder money to generate profits. High return on equity is usually a positive sign. Free cash flow. Free cash flow is the cash left after expenses and investments. It shows how much money a company has to grow, pay debt, or return to shareholders. Debt to equity ratio. This compares a company's debt to equity. A high DE ratio means a company is using more debt, which can be risky. Revenue. Revenue is the total income a company brings in before any expenses. It's the top line of a company's income statement. Profit margin. This shows how much profit a company keeps from its revenue. Higher margins mean better efficiency and more money kept after expenses. Guidance. Guidance is a company's forecast of future earnings or revenue. Strong guidance can boost stock prices. Analyst rating. Analysts often rate stocks as a buy, hold, or sell. These ratings are based on research and earnings estimates. Risk and strategy. Diversification. Spreading your investment across different assets or sectors. It reduces risk by making sure one bad investment doesn't hurt your whole portfolio. Risk tolerance. Your ability and willingness to handle investment losses. Younger investors usually have higher risk tolerance due to longer time horizon. Asset allocation. The mix of stocks, bonds, and other assets in your portfolio. It's based on your goal, age, and risk tolerance. Rebalancing. Adjusting your portfolio back to its target allocation. You might rebalance yearly or after big market changes. Dollar cost averaging. Investing a fixed amount regularly. It reduces the impact of buying at the wrong time. Buy and hold. A strategy where you invest and keep holding over the long term. It focuses on time in the market, not timing the market. Short selling. Betting a stock will go down. It's risky because losses are unlimited if the stock keeps rising. Margin/margin calls. Investing with borrowed money. If your investment drops too much, your broker may demand more funds. Volatility index. Known as the fear index. It measures expected volatility in the market. A high VIX means more uncertainty. Trading and orders. Market order. In order to buy or sell immediately at the best price available. Fast execution but less price control. Limit order. In order to buy or sell at a specific price or better. It may not execute if the market doesn't hit your price. Stop loss. A tool to sell a stock automatically at a certain price. It helps protect against bigger losses. Bid/ask. The bid is what buyers are willing to pay. The ask is what sellers want. The difference is a spread. Spread. The gap between the bid and ask prices. Tighter spreads mean more liquidity and efficiency. Volume. The number of shares traded in a certain period. High volume means more activity and easier buying or selling. Liquidity. How quickly you can convert an investment to cash without losing value. Stocks are generally liquid. Real estate is less so. Tax and retirement terms. Capital gains tax. You pay this tax when you sell an investment for a profit. Long-term gains, over 1 year, are taxed less than short-term gains. Roth IRA and traditional IRA. Retirement accounts with tax perks. Roth grows tax-free. Traditional is tax-deferred until withdrawal. 401k. A retirement plan offered by employers. You invest pre-tax money, and many employers match your contributions. Tax-deferred/tax-free. Tax-deferred means you delay paying taxes. Tax-free means no taxes on future withdrawals. Cost basis. The original price you paid for an asset. It determines how much gain or loss you report when you sell. Wash sale rule. If you sell at a loss and rebuy the same stock within 30 days, you can't claim the loss on your taxes.